Hi guys, how are you? In today's video, we'll be talking about the stock market. I want you to understand the concept of how to invest in the stock market and park money. So, if you are wondering how to invest in the stock market and make money like me, this video is definitely for you. In 1 hour, we'll be disintegrating, digesting, diffusing, scintillating, insulating, dramatizing, indicating, whatever you call it, give it a name. We shall be digesting the concept of how to effectively and properly invest in the stock market to pack all the money that exists in the stock market. So if you are interested to pack money in the stock market like me, let's observe the tradition in this channel. We smash the like button. We smash the subscribe button. If you want to make this money in the stock market, smash the like button. Smash the subscribe button. Smash her. Smash it, Joe. Veronica Kunta. Subscribe now so that we can start packing this money in the stock market. I want to ask you a very simple and basic question. If you want to make money, what do? Get a job. Thank you. Everybody knows that if you want to get money, make money, you get a job. What if you want more money? What do? You get more jobs. You are very smart. So now what if you need much more money? What do? You keep getting more jobs. As fantastic as it sounds, there's a problem with it that you and I have recognized. First, we only have 24 hours in a day, and you can't work for the complete 24 hours. Nobody works for the entire 24 hours. It's even advisable to sleep at least 7 to 8 hours per day. So which means that you are left with 16 hours. And you still have to shower, do your daily routine and things like that. So which means at best you have like 2 jobs or 3 jobs. And that's one problem with that. Our time is constrained. And 2, the problem with getting more jobs in order to have more money is there will be a time when you cannot work. It's either you are sick or you are 65, you are old, you may not be able to work, or there could be one reason or the other why you may not be able to work. So which means that you cannot earn. Because if you're following the strategy of you need a job to get money, and to get more money, you need more jobs. So it means that if you fall sick, you won't be able to work, then you won't be able to have money. I'm sure that you don't want to beg on the street because you are old. Some people are like, yeah, if I'm still and I cannot work, I have pension. You and I know that pension has nothing to offer us these days. So the question is, there's a flaw with the current system of if I need more money, I do more jobs. It's not bad that you need money and you get a job. Everybody do that, including myself. But what if there is a way that you can make your money to work for you? So while you are doing your job and you make money, the money you've made now will be making more money for you. So that the days that you are not able to work, the money is making money for you. So that the days that maybe you are sick or you don't feel like working, the money will be making money for you. What if there is a way, a legitimate way, that the money you've already made can be making more money for you while you do nothing? That's the concept of investing. That's why I love investing so much. Investing is not against you working. No, I have a job myself, so I'm not saying you should quit. I have my own job. All I'm telling you is, what if the money that you make from your job, let's say from the first month of January, is able to make money for you? So as you continue to work through February, March, April, the money that you made in January is making money for you, February is making money for you, March is making money for you. So you are working, making your own money, and the money you've already made now is also working by itself automatically to make more money for you. So you see, it becomes easier for you to get rich. It becomes easier for you to live a happier life. It becomes easier for you to afford what you want. Because this second stream of income is not what you are working towards. You're no longer working towards it. You are just doing your normal job, and the money you've made now in the past is working to make money for you. In fact, sometimes it even makes more for you than what you are making using your strength, using your energy. It sounds too good to be true, but that's the truth. That's what we call investing. So if you think I'm lying, if you put your money in the bank, what happens? The bank pays you an interest for keeping your money with them. Exactly. So the interest they pay you is a way of telling you, thank you for keeping your money with us. Of course, the bank will lend the money to other customers, and those people pay interest to the bank, and the bank pays you out of that interest. But the problem with saving your money in the bank alone is that if you save like $1 million for a year, you'll be lucky to get an interest of $1,000 for 1 year. You'll be lucky. So imagine that you are saving $1 million for 1 year. At the end of 1 year, the interest you will get on your money may not be up to $1,000. So you see, even though the bank will give you some money for saving with them, the interest rate is very, very small. 0.001%, 0.2%. Even you get 2% interest rate. That means you have to lock your money and sign document on terms and conditions and several other things. So it's not a very efficient way of increasing your money. It's not the best way to make your money work for you. So you see why savings is good. You can get your money from the bank whenever you need it, but it does not work for you to bring more money to you. It has a problem with inflation. What's inflation? I like giving an example with a pen. This pen, let's say it cost $1 this year. Next year, the price will increase to $1.02. 5 years time, the price will increase to $1.1. 10 years time, the price will be $2. So you see, over the years, the price of item rise, and your money is not rising as much as the price of items are rising. So we want a method so that the money we have will rise higher than the price of items. The increase in price of items over a period is what we call inflation. So we're looking for a way so that our money will increase at a higher rate than the rate of existing inflation. Inflation is supposed to be 2% every year, but in the US, as of today, the inflation is about 7%. So which means what your money can buy yesterday, you need to increase it by 7% today in order for you to afford it. So what if the money now that you have in the bank can increase at that same rate or even at a higher rate? So all these things introduces us to the concept of investing, why we should invest. The main aim of investing is to increase your money so that it will be higher than the inflation rate. Is to increase your money so that your money will work for you. People say money does not grow on trees, but you and I know that money these days grow on trees. The tree is called investing. We are saying that there are different areas you can invest in: Bitcoin, land, NFT, cryptocurrency, real estate, wristwatch, gold, oil, private equity, hedge fund, mutual funds. There are several things you can invest in. Things you can buy and hold it. By itself, over a period of time, the price of that thing would increase. Then you sell it to collect your profit. So one of the things that you can invest in is called stocks. So that brings us to this class, what we call stock market investing. In this class, our interest is on stocks and shares. So question is, what are stocks? What are shares? As one of the route for investment. So instead of just buying only house, or you are buying only Bitcoin, or you are buying only land, what if you can also invest in the stock market? You just buy the stock or the shares, you hold it. Over time, let's say 1 month, 2 months, 3 months, 5 years, 10 years, the price have tripled. The price have increased by 10 times, 100 times. Then you sell it. So you are buying it at $100 and you are selling it at $1,000 over a period of a year or 2 years or 3 years. Wouldn't that be interesting? And remember, the concept of investing is we don't want to stress ourselves. We just buy it. By itself, the price will increase. Then we sell. So I'll use my money that I've worked now to buy it. and by itself, it will be making money for me. I don't have to be stressing myself. Oh, come, I want to work on it. I have to split my time between my day job and my investment. No. As you do your job, the money or the investment will be increasing by itself. That's the concept of stock market investing. Can't you see now that the concept of investing in the stock market is simple, is relatable, and is sweet and exciting? The question is, what are stocks? What are shares? I've heard everything you've said. They sound very good. Okay, what is a stock? What is a share? And why should I invest in a stock than in buying a property or buying land or buying a wristwatch? Why should I invest in the stock market? That's a very good question, or questions rather. A stock represents equity ownership in a company. Equity ownership in a company. It means you are buying a part of a company. Let's use Apple or Amazon as an example. If you buy the share of Apple, you are buying a piece of ownership of Apple. Let's say the ownership of Apple is like a pizza. A pizza, it's always round. If you want to eat it, you don't just pack the whole thing and force it into your mouth. No, you cut it piece by piece, piece by piece. So let's take one piece. A piece of the pie is what we call a share. A share of the whole pie. Is it not? So that piece, a share of it is what we call share in the stock market. So a share is just one piece of a company. Let's say the ownership of the company is 100%. So it means that 1% of it, 1 over 100, is a share. A stock represents equity ownership in a company. So we are saying that if the ownership of a company is 100%, this is what we call a stock, the complete ownership of a company. So if you start a company by yourself, you may own all the ownership of the company, all the rights of the company. But if it's a very big company, one person does not usually own a very massive company. He will have some percentage ownership. So the whole pie, you are seeing this pizza, the whole pie, which is 100%, is what we call stock. And it's called equity ownership. Equity ownership means you own the asset and liability of the company. Now, a share is just 1 out of 100%, 1 over 100. That's what we call a share. A share is just a piece of the company. This pizza you are seeing here, if I take this one out, a piece of the pizza, this piece, one piece of it, is what we call a share. But a stock is the whole entirety, the complete 100% is what we call a stock. And it represents equity ownership of the company. It means you own the company. So if you own a share, it means you own a piece of the company. You don't have to work in the company. You are the owner, so you don't have to work in the company. But you own it. That is what a share represents. So the concept of shares and stocks is the concept of owning companies by right, by laws and regulations of the country. You own a piece of the company. So let's say you're an investor. Someone comes to you with their business idea and they're like, yes, I have a business, but I need some money from you. And you're like, okay, I'll give you the money you're asking for, let's say 100,000 or 1 million. But what will I get in return? Oh, the person is like, okay, if you give me this money, you will own about 50% of the company. Good. It's very easy for you to understand. So the same thing also happens when we talk about shares and stock. So if you buy a share, you are buying ownership right of the company. You are like that investor that giving your money, and because of you gave your money out, you acquire some ownership right. That ownership right of the company is what we call equity. So stocks is the same thing as shares, and it's the same thing as ownership. That's what we have here. Stock or capital stock, whatever they call it, it's the same thing as shares. It's the same thing as equity. And it means ownership. It means you have ownership right of the company. So when you buy a share, you are buying a piece of ownership right of the company. So So it means now you are part owner with other people that have the right. So if the right of ownership of a company is 100%, once you buy one share, you are buying 1% of it. If you buy 1%, of course, that's your ownership. So the ownership of a massive company is divided into fractional dimensions. It's small businesses that one person own everything. If it's a big business, a lot of people own different percentage in that company. So once you buy a share in a company, you're getting some percentage ownership of that company. So you and other people decide what happens to that business, if it goes up or if it comes down. And the good thing is that you don't have to work in that company. You buying the share means you are among the rightful owners of the business. A share is a piece of a company. A stock is the total shares in a company. So the question is, why should I invest in a business through shares? Historically, we've seen that stocks have outperformed other investments over the long run. The value of a real estate doubles every 10 years. But if you invest in stocks, it can double over 1 year. It can double over 2 years. So the return you get investing in stocks is much higher than other types of investment. So that's why we want to invest in stocks. We want to become business owners with Elon Musk, with Jeff Bezos, with Steve Jobs, and other big names in the industry. Even though I've explained a lot about the concept of becoming a business owner, most people that invest in shares and stocks are not interested in the part of saying I'm a business owner, even though they are business owners. They just want to buy the share of the company, they will hold it, and once the price has increased, they will go and sell it. So it's the concept of buy, hold, and sell. You buy a share of a company, let's say Apple, for $100. You are buying the share of Apple for $100. Then you hold it, which means that you do nothing else. Over 3 years, over 5 years, the price will move from $100 to $120. Then you can go and sell it. Of course, the profit of $20 is now yours. It's all yours. Congratulations. So we invest in the stock market for 2 reasons. 1, to get profit, which I've explained to you. In the stock market, we call it capital gains. It's the profit you get on your investment. And also, people invest in the stock market to get dividend. You know that if you buy a real estate property, someone is like, yes, if I buy a real estate property, before the price will double in the next 10 years, I'll be getting some rental income. Good. If you invest in the stock market, those rental income that comes with real estate, you also get something similar to that. In this case, we don't call it rental income, we call it dividend. So it's like the company that you invest with will pay you some money as a thank you for investing with them. It's similar to getting like rental income. So every quarter or every year, depending on the business that you invest with, they'll be giving you some money as an appreciation, as a thank you for investing in the company. So that money that they give you to appreciate you for investing with them is what we call dividend. Finally, you enjoy the benefit of compounding. Einstein said that compounding is the 8th wonder of the world. Let's take an example. Before I will use a calculator to show you the benefit of compounding. We are still discussing why investing. If you have $20,000, for example, let's say you have $20,000. There are 3 things you can do with that money. 1, you can either put the money under your pillow, you hide it under your mattress. It's my money. I don't want thief to take my money. Okay, good. Or you keep the money in the bank as a savings, or you invest that money. There are only 3 options you can do with your money. Number 1, under the mattress. So if you hide your money under your mattress, you don't want thief to come and take your money. Thief can even bust into your house and take the money. At the end of 30 years, that money will still be there. Your $20,000 will still be there. But inflation would have risen. What $20,000 can buy today, in 30 years' time, $20,000 can no longer buy it. You will need more than $20,000 to buy it. So that's the problem with keeping your money under the mattress. So you see, the money has not made any money for you. Price of goods and services are rising every day. And what $20,000 can buy today is no longer able to afford it in 30 years' time. So which means you are already losing, even though the $20,000, the face value has not changed. Okay, you're like, that's not a very good method. Armed robbers can even steal my money. Let me go and put it in the bank, which is what most of us do. We call it savings. We save the money in the bank. Let's say that you are the luckiest person in the world and the bank offers you a 2% interest rate. Bank don't offer it. So you have to be extremely lucky to get a 2% interest rate from the bank. If you get a 2% interest rate from the bank for keeping your money with them for 30 years, what you will get is 36,337. So your money would have increased from $20,000 to about $36,000. This is after 30 years. Your money have increased, yes, but your money have increased with inflation. Inflation increased by 2% every year. So which means what your money can buy today, in 30 years' time, it can buy it and nothing else. You've matched inflation rate. So you see, you didn't really have a return for your money. The return you get is just about $16,000 over 30 years, remember. So what if you invest the money in the stock market? Your $20,000 would increase depending on the annual return or the interest rate return. If your return is very low, you can get a return of 5.5%. That's even like a low return in the stock market. So which means your money would have increased from $20,000 to $99,000. So your money would have increased from $20,000 to $99,000. Is that not fantastic? So in one case, your money did not increase. Second case, saving your money in the bank, your money only increased to 36. But if you invest in the stock market that we are talking about, your money will increase from $20,000 to $99,000. That's if your return is just 5.5%. So I will take you through other returns. What if your return is 10%? What if your return is 20%? What if your return is 50%? Let's use a calculator to check the impact. We are here on Google and I just type compound interest calculator. Click on anyone that you like. Let's just see what it will give us. So we are saying that we are depositing $20,000 in the stock market, or we are investing $20,000 in the stock market. And our interest rate, I've shown you the first one, where if the interest rate is 5.5%, your return is about $99,000. What if your return is 10%, which is the average return in the stock market? In the stock market, the average return for a period of 90 years historically was 10%. So which means you invested $20,000 in the stock market, have a return rate or interest rate of 10%. Let's see what it will give us. So you see, we're investing $20,000 with an interest rate of 10%. For how long? 30 years. Let's see the return. Whoa! So your money will increase from $20,000 to $348,000. Wow! That's a lot. So your $20,000 for a period of 30 years invested in the stock market with an interest rate of 10% would become about $350,000. Remember, all you did was just to invest and do nothing else. You kept living your normal life. After 30 years, your money has increased from $20,000 to about $350,000. So you see why we invest in the stock market. The return can be mouth-watering. It can really be a lot. Let's double the interest rate to 20%. Are you seeing what I'm saying? If you get a return of 20%, your $20,000 will become $4.7 million. $20,000 will become $4.7 million. Wow. So you see why I am passionate about the stock market. You see why I love the stock market. It can transform your life, transform your money. It can transform your transformation. This is a classic example of why investing in the stock market is important. Let's even say that you invested $100,000 for 30 years with an interest of 20%. So let's see what $100,000 will become after 30 years. It will become 23 million. 23 million if your interest rate is 20%. So if your interest rate is 50%, if your return is 70%, if your return is 90%, imagine how much you'll be making just only for investing in stocks and shares. So you see the reason why I love investing in the stock market. It can change your life entirely. Let's take real life examples so that you won't think that I'm making this up in my head. You can buy the shares and stocks of any company, but let's just take Tesla as an example, since it's very popular. Tesla share price. See, I'm on Google. Type in Tesla share price. You see Tesla's share price. Let's see the performance over days and years. So at the top, this is 1 day, 5 days, 1 month, 6 months. Year to date means from the beginning of the year to this date. We have 5 years, we have maximum. This is the performance of Tesla shares over the years. You see, there was a time that Tesla shares was selling for $5 as of 2011. So if you have bought Tesla shares, one share of Tesla was selling for $5 in 2011. As of today, it is selling for what? $923. That's over many years now, over 10 years. So it moved from $5 to about $923 over 10 years. Imagine the return. We'll do a calculator. So it means from one share, your profit is 923 minus 5. So from one share, you're getting a profit of $918 from a share. If you have bought more than one, let's say you bought 1,000. So your profit will be $918,000. That's almost close to $1 million. So you spent about $5,000 and you hold it for 10 years in the case of Tesla shares. And the return you are getting is about $918,000. So what you invested $5,000 for is giving you $918,000. Let's do example 2 with Apple. See, this is Apple share price. There was a time Apple share price was selling for $0.12. See. So let's say in 2012, you bought Apple share for $15. You see, 2012, $15. As of today, it's selling for $172. Let's do the mathematics. So 172 minus 15. So your profit has increased by $157. This is just for one share. So if you have bought more, it means the profit, of course, will be more. So if you have bought, let's say 100, let's keep it simple. So you'll be getting about $15,000. And you bought it for $1,500. So you see why investing in the stock market is so exciting? Because it has the potential to increase your money and you are doing no work. You are not doing any job. You are not answering yes ma'am, yes sir to anybody. You just buy it and hold it. When the price has increased to what you want, you click a button, sell, and you sell it. It's as simple as that. Let's do the last example with Amazon. Amazon shares. See Amazon share price? There was a time that Amazon share price was selling for what? $100, $90 here. So in 2009, Amazon share price was selling for $90. As of today, see the price. See the price as of today, $3,000. Let's do the mathematics. 3152. 3152 minus 90. So the profit you get for one Amazon share is about 3,000. And I'm saying that you can buy more than one. If you have bought 100, so your profit is about $300,000. And mind you, you only invested just $9,000 in 2009. As of today, your profit is over $300,000. So this is what we mean when we talk about the stock market. You see, it can really, really be profitable. It's one of the best investments in our modern time. It's so exciting. It's so sweet. Goodness. This is what we mean by compound interest. You see, the price increase over time. Over time. The money will keep adding over time. The price will increase over time. Let's look at BlackBerry shares so that it looks as if it's only one way. This is BlackBerry shares. There was a time it was selling for $102 Canadian dollars. You see, 102. As of today, the price is selling for 9.55. So which means if you have bought it for 102, you would have lost about what? $92. So you see, why you can make profit in the stock market, you can equally make a loss in the stock market. So which means the best thing to do is to buy stocks that can give you profit, because it can go both ways. It can go up or come down. I know that I've been preaching about going up, going up, going up. You make profit, your money will increase. I've been talking about it. But I also want to give you the other side of the coin, that you can also make a loss while investing in the stock market. And I gave you an example with BlackBerry. If you have bought the share price of paper just last year, it was selling for $300. As of today, the share price is what? $126. So which means you would have lost money. That's 300 minus 126. So which means you would have lost about $174 just from one. If you have bought 100, so which means you would have lost about $17,000. So you see, as much as you can gain from the stock market, it can go up for you. If it works for you, it can really be a miracle. Also, it can also work against you. So it's a two-sided coin. So our goal now is to pick stocks or to pick investments that will go up. Of course, nobody wants to lose money. People ask me, which share should I buy? A lot of people are like, okay, I'm about to buy a share. Which one should I buy? Can you advise me? Nobody can give you that advice on what to buy, because people want to avoid risk. What if you lose money? Show you examples where people can lose money investing in the stock market. So the question is, the share you want to buy depends on the kind of investor you are or you want to be. We have different kind of investor: growth investors, value investors, income investors, and wealth preservation investors. When we say growth investor, it means you invest in growth stocks. Growth stocks are stocks that their share price keep rising, like Amazon, Apple, Tesla. They are mostly tech companies and biotech companies. Their share price are on the rise. We equally have alternative energy stocks. So these are stocks that the share price are rising. There are advantages and there are disadvantages. The advantage is obvious. The share price would increase. The disadvantage is that they don't pay dividend because they're using the profit to invest in the business. So most of them don't pay you a dividend. They're using it to invest more into the business. It's like a growing business. So there are businesses that are like interested in growth. They want to expand to China, to Nigeria, to South Africa. These are businesses that are like expanding, and are mostly in tech, biotech, and alternative energies. A good example is Apple, Amazon. They're always thinking of a new brand, something new to create, something. These are businesses that like creating new things every now and then. A classic example is Amazon. Amazon website, Amazon Kindle, Amazon bookstore, Amazon this, Amazon that. They're always coming up with creating products. So it means that if you buy this kind of share, the share price would likely rise. A disadvantage with growth stock is if something can rise, let's say by 20%. In finance, we believe that it can drop also by 20%. It can go up, it can come down. So if something can rise by 50%, it means that it can equally drop by 50%. If it can rise by 100% to double your money, It can drop by 100% to vanish your money. So, see paper. I'm a fan of paper. It was going up, going up, going up, but see, it's dropping massively. It's dropping massively. And paper is a growth stock. So, which means that, if it work for you, like in the case of Apple or Amazon, see Apple. Let's go to Massimo. See what Apple, you see Apple. This Apple share price is going up. It's going up. It's a growth stock. PayPal is also a growth stock. It has gone up, but it's coming down. So that's the risk. If it can go up, it means it can come down. If they create a product that the market love, that people love so much, the share price will go up. But if they create a product that people don't like, the share price will come down. Since these businesses are always creating new product, the question is, will they keep creating new product that people will like? Because if they create new product, iPhone 102, and people love it, the price will go up. But if they create iPhone 170 and people don't like it, the share price will plunge, it will tank, it will fall down. We equally have what we call value stocks. These are stocks that appear to be undervalued and you hope for the price to rise. Warren Buffett became a billionaire by investing in value stocks. Value stocks are stocks that the market does not value so much, but you have an eye to know that this business will blow up in the future. So you invest in them now so that when they blow up in the future, your money will jump up. So that's what we call value stocks. We equally have income stocks. These are companies that pay regular dividend. They are mostly well-established firms like Coca-Cola, Pepsi, P&G, AT&T. They are very stable companies that are very stable and have been around for about 30 years. So they can pay you a dividend, which is the advantage. But the disadvantage is that their share price don't usually rise so much. It rises by 5%, 10% on a yearly basis. If you want to be getting regular dividend, it means that the share price may not rise so much. So if you are someone that's interested in getting rental income, as we call it, which we call dividend, you invest in companies that have been around for several years and are very stable, like Coca-Cola. But also, the share price is not like the growth stock where it increased by 50%. The share price for income stocks increased by 5%, 7%. They grow steadily. But for growth stock, they jump so much. Also, we have wealth preservation stocks. These are stocks that people just want to use to preserve their money. You are like, I don't want my money to jump up by 50%, but please, I don't want to lose my money. So I just want something that's steady. It will grow by 1%, 2%, so that if it drops, it will drop by 1%, 2%. I've told you in finance, we have a theory that the higher the risk, the higher the reward, and the lower the risk, the lower the reward. So if your share price can jump up by 20%, it means it can jump down by 20%. But if it can jump up by only 2%, it means it can jump down by barely 2%. So wealth preservation stocks are stocks that don't rise so much. They increase by 1%, 2%, 3%, so that if they fall by 1%, 2%, they're not so exciting, they're boring. But people use them to preserve their money. And they're mostly blue chip companies. Blue chip companies are companies that are in Dow 30. I'm throwing a lot of words to you. So let's browse online for me to show you Dow Jones companies. Dow 30 is also called Dow Jones Industrial Average. It simply has 30 large companies in the US. These companies are very stable. They are steady. They have been there for like 30 years. They're very stable. So they have been there for since almost like the creation of time. These are the companies that are in Dow 30. Chevron, Goldman Sachs, Johnson & Johnson, Coca-Cola, JP Morgan, Microsoft, Salesforce, Walmart. You see, these companies that you're seeing here are very steady. Their share price don't rise so much and does not fall so much. So if you want to just preserve your wealth, you are like, I just want something steady. You can invest in all these companies here, or you can even invest in Dow 30. So you can invest in all of them instead of just picking one by one. Hi guys, welcome to this class, mutual funds. Mutual funds and exchange traded funds. So what are mutual funds and what are exchange traded funds? what are the pros and cons of these funds compared to stocks. So simply put, a mutual fund is a basket of stocks. We'll be talking about stock. So instead of buying only one stock of a company, we will buy a fund, and the fund has several companies in it. Picking stock is like a serious business. If you pick the right stock, you can become a millionaire in a year. If you pick the wrong stock, all the money you've invested, you can lose it or lose most of it. Picking stock is really like, it's a daunting job. It involves fundamental analysis, technical analysis, PE ratio, PS ratio, PB ratio. It involves a lot of mathematics. And I don't want to go into those mathematics in this class because it will make this class more serious, like an advanced stock market class. I want to keep this class at a beginner friendly level. It's for beginners. So the best thing that Warren Buffett advised, who became a billionaire by investing in stocks, is don't pick one stock. It's very risky. Don't pick one stock. It's very, very risky. Instead of picking one stock that's risky, buy a collection of stocks. Through that way, your risk will decrease. Do you understand it now? So Warren Buffett became a billionaire by investing in stocks. But he does not pick one stock. What he buys a collection of stocks. Like what I showed you before, do 30. So he buy 30 stocks in one. So instead of just buying Chevron or buying Pepsi or buying Coca-Cola, you buy a fund. That's what it's called actually. You buy a fund that has all those companies all in one. He was like, that's what made him a billionaire. So that will lead us to talk about mutual fund and exchange traded fund in it. Let's take, for example, S&P 500, X and P 500. So S&P 500 contain the largest publicly traded companies in the US, the top 500 of them. And you see, S&P 500, it has 500 companies in the US that are publicly traded. If you buy into this fund, you're not just buying the share of Apple and Amazon. It has Apple, Amazon, Netflix, Pepsi, Coca-Cola, the top big firms in the US. So instead of just buying Apple share, PayPal, or buying one or the other, you want to hedge your risk so that if PayPal shares is falling down, your money will not plummet with it. So you want to diversify your risk. So instead of just investing in one stock, you buy a fund, and the fund already have different company shares in it. A mutual fund is an investment that pulls money from many people and invests it in a mix of investment. So what we call a mutual fund, it can be a company, it can also be an investment. It's a company that collects money from different people and put the money in a certain type of investment. So in the case of S&P 500 now that I've explained to you, the company now, we invest in 500 largest companies in the US. So they will invest in each of them. When we buy this S&P 500, we are buying a part of the investment that they have already made. Or they will use our money and add to their own money to invest in all these companies. So instead of you investing in 500 companies in the US, you're buying them one after the other, one after the other. People advise that you buy a fund that already have 500 largest companies in the US. So that if one company is going down, like PayPal, other ones will be going up in order for you not to lose your money. Over the years, the return of S&P 500 is about 10%. So if you invest in S&P 500, the return you are expecting to get every year is 10% of your money. Of course, there are some years it will go up by 40%, 50%, which means there will be some years it will come down by the same amount. But if you do the average over 90 years, the return you will get is 10% for each year per annum. When people talk about the stock market, I'm investing in the stock market. Most times they are talking about this S&P 500. So people don't like picking shares because it can be very risky. If you pick a stock of a company, let's say Apple or Amazon, you can be lucky and get a return of 70%. But if you pick PayPal now, we've seen what PayPal is doing. You can lose most of your money. So people don't want to lose their money. So they're like, let me invest in a group of shares that overall will go up. Instead of picking one company, one can give me 70% profit and the other one will give me 90% loss. So most people invest in a group or in a basket of stocks rather than just picking only one stock. You are trying to minimize your risk. I've told you the S&P, the return is 10%. If you have picked a company that's profitable in S&P, the return will be higher. But question is, how do you know the one to pick that will give you that return and not give you a loss? Since you are starting, I'm teaching you about investing at a beginner level. I will even encourage you to go for a fund, a basket of stocks. So you buy the fund, and inside that fund, it already has different stocks inside it. And it can be in two ways. It can be in mutual fund or in exchange traded funds. When we say mutual funds, as the name implies, mutual and funds. Mutual means a group of people are doing something together. So in this case, they are putting their money together in order to invest in stocks. So instead of a group of people all over the world putting their money together, a company is doing it on behalf of those people, like Vanguard, for example. So Vanguard can collect money from different people. You put your money, they collect money from other people, and they will use it to invest in a group of companies on behalf of those people. So that's what we call mutual fund. So there are things you enjoy if you invest in mutual fund. There are things that you miss out when you invest in mutual fund. So some of the advantages are professional investment management, investment objective, diversification, economies of scale, liquidity, government regulations and oversight, service and convenience. If you don't know the stock to pick, or if you're not sure the stock you pick will give you a profit, you don't want your heart to be panicking or to be checking the stock market every now and then, you should invest in S&P 500. S&P 500 can be a mutual fund, can also be an ETF. So what are the disadvantages of investing in a mutual fund? You see, if you invest in a mutual fund, the company now that you're investing with is the one that do the decision on your behalf. So you won't have any voting right. You can't customize it. Most times they have high expense ratio. Liquidity is an advantage, sometimes can be a disadvantage. For a mutual fund, you can only sell at the end of the trading day, and you can only buy at the end of the trading day. So there's fluctuation and there's less control. So because almost like you're giving your money to a company, and the company now is pulling money from other people and investing on your behalf. So I've shown you the advantages and the disadvantages. Ideally, they are supposed to beat the market. They're supposed to give you a return that's more than 10%, because 10% is like the average return from the stock market. So ideally, they're supposed to give you a higher return, but are they able to give you that higher return? So far, most of them have not been able. Now let's look at what we call exchange traded ETF. Exchange traded ETF is a type of mutual fund. The only difference is that it trades within the trading hours. So like in most countries, the trading time starts by 8 a.m. Like in the US, it starts 8 a.m. and the market closes by 5 p.m. Normal 9 to 5 or 8 to 5 job. What we're saying that from this mutual fund, if you want to buy it, you have to wait for the market to close by 5 p.m. before you can buy or sell it. But there's a type of mutual fund that you can buy during this period, during these trading days. That type of mutual fund is what we call exchange traded fund. That's what we call ETF. Is exchange traded, which means you don't have to wait till the close of the day before you buy it. It trades almost like stocks and shares. So stocks and shares trade within the trading hours. You can buy stocks and shares from 8 a.m. to 5 p.m. So exchange traded funds are mutual funds that trade within those periods. But mutual fund on its own, as we know it, they trade after 5 p.m. or before 8 a.m. There's not really like a big difference between mutual funds and exchange traded fund, except for the trading hours and also for the fees. Most exchange traded funds are low fees. They are very cheap to buy. The commission they charge you is $0 or 0.2%. So they are very cheap to buy. If I want to buy a share, which is what is important to you, how do I buy a share? You don't just walk into Apple or walk into Amazon or go to the Amazon website like, I want to buy Amazon share. You can't buy it on their website. That's not the way it's done, because I told you that things are done through the stock exchange to ensure that things are done properly. So you can't buy Amazon share from Amazon website. You can't buy Apple share from Apple website. You can't even walk to Apple head office and like, yes, I have come to buy your share. No, that's not the way it works. You have to buy it through a broker. You have to buy it through what we call a stock broker. A stock broker is like an institutional investor. So he has bought the share from Apple in large quantity. Now we'll be selling to you and I in little pieces. 10 million, 1 million, 100,000, $5. The stockbroker is like a wholesaler, someone that have shares in large quantity and will be selling to people that want to buy at a retail level. So we have several of them like Robinhood, eToro, IG. There are several of them. If you just take your phone and Google best stockbroker in my country, you will see a lot of them that will show up. So that's where you and I now we go and buy shares. You don't go to Apple to buy shares of Apple, no. You go to a stockbroker to buy the shares. And I've given you the top ones. The US, Robinhood is very popular. In the UK, eToro, FeeTrade, IG are very popular. So please just check online and type best stockbroker in my country. It will show you the list of stockbrokers. So that's where you and I now go and buy shares. They are called discount brokers because most of them sell shares with little to no commission. If you buy from eToro, the commission you pay, the fees you pay for buying shares is almost $0. eToro actually offers buying shares at no commission. They are called discount brokers or discount brokerages. It means the same thing because they sell shares to us at little to no commission, at a discounted commission. So please, one of the things you should look at when you are picking a stockbroker, look at the fees they charge. Most of them charge you a fee or a commission for buying shares from them. So please look at it. It's called expense ratio. How much you are spending, how much fees they are charging you compared to how much shares you are buying. So ensure that it's less than 1%. In fact, most of them offer $0 commission. So which means that you're not paying any commission at all. And also ensure that the stockbroker is regulated. Ensure the stockbroker is regulated because your money will increase, hopefully. You don't want when your money have increased, you want to take back your money. They're telling you stories. So please ensure the stockbroker is regulated. In the UK, the regulation is FCA, Financial Conduct Authority. So in some countries like US, it's SEC regulated, Security Exchange Commission regulated. So it depends on the country that you are staying in. It will determine the regulation. But please ensure that the company you're buying from is regulated to avoid story that touch, to avoid things going bad. And also some of them offer an account minimum. Some of them offer no account minimum. So it depends on the amount that you have. But if there's a minimum, usually like $5. But I would still prefer for you to go with the one that offers no account minimum. Some of them you can invest at $1, $10, $20, $50, depending the amount that you have. Whatever you have is enough for you to start investing. And some of them may have so many shares, some of them may have few shares. So ensure that the one you are picking has the share you want to buy. Let me give you some tips on how to invest. So before you start investing, I prefer to pay off my credit card debt. So if you have any debt that you are owing, like credit card debt, but if it's student debt is not so much. The interest rate is not so much. So you can invest and still have student debt. But credit card debts are very expensive. The interest rate is very high. So please pay off your credit card debt before you start investing. Also, before you start investing, it's good for you to have emergency savings or emergency fund. Have a money that in case of emergency, you can always go and pull back. And people advise about 3 to 6 months of your monthly salary. So which means your salary for 3 months to 6 months, you keep it in one place as your emergency savings. So that when you have an issue, instead of going to sell your shares, you will go and pull it from your emergency fund. Because you selling your shares every time you have issue will make the price not go up so much. You want to reap the reward of compound interest. You want to keep adding to it instead of going adding and taking from it, take from it, take from it. It will make your interest to be going up and down. So you want something that will be going up continuously. So in order to have what will go up continuously, it's good to have like a savings that you know that you will fall back on in case you have any problem. Also, start investing now. The earlier you start investing, the better. The best time to start investing, from what I've showed you about Amazon, Tesla, Apple, is 10 years ago. That's the best time. But since 10 years ago have passed, no need to cry. The second best time is now. Start investing now. Even though it's $10, $20, it doesn't have to be $1,000. Start investing now. Their share price may look high, like in case of Amazon, it's more than $3,000. But the good thing is that if you buy from all these brokerages that I've shown you, they allow you to buy fractional shares. So you can buy a fraction of the shares. You can buy a fraction of the shares, and the return is the same thing in terms of percentage. So don't be crying, I don't have $3,000 to buy one Apple share. No, you can just spend $30 to buy a fractional share of Apple or a fractional share of Amazon in this case. So please start investing now. The earlier, the better. And little is better than nothing. Instead of crying, you don't have enough money, $10, you have it. Start with it. Also, think long term. Think long term. Start investing. Think of taking the return in 10 years, in 30 years, in 20 years. Don't just buy today and sell tomorrow. The return you will get will not be worth the effort. Also, you are likely to get like a higher return over the years than over many years than over few months. So grow your investment. Keep adding to it. Keep growing your investment. Keep growing your investment. Keep adding to it instead of going to remove it or going to sell it whenever you have a problem. That's why I advise before you start investing, have emergency fund or emergency saving. Now let's talk about how do you manage risk when it comes to investing. I've been talking about higher risk, higher return. If you want to have a muscular body like our friend here, you want, to have muscle, look like a very fine guy that ladies will admire, you don't go to the gym once and expect to have a very muscular body. It takes time. You need to be going to the gym over and over again, to be exercising, to grow your biceps and your triceps and your triceps and your quinceps and all those steps that they talk about, which means that it takes time. It takes time for you to start getting substantial return. So people that invest for 10 years, 20 years, 30 years, and they keep adding to it instead of even removing from it. The longer you go to the gym and exercise, the more you build your muscle. Same thing happens with investing. The more you leave your money in your investment portfolio, the higher the probability of it increasing. Also, another way to manage your risk is diversification. Don't just invest in one company. I know you want to invest in the one that will give you 2,000,000% return. Hey, easy. So that's why my advice is go with ETF. Instead of picking one company stock, go with ETF. S&P 500 is most people's recommendation, S&P 500. So invest in a fund that invests in different companies. They invest in health, they invest in tech, they invest in different areas. And a classic example is S&P 500. Also, we have what called dollar cost averaging. How should I buy shares? You can either buy with a lump sum, or you can buy on a monthly basis or on a weekly basis. So this here simply means dollar cost averaging. So instead of just spending $2,000 to buy shares, what the advice is, you can be spending it little by little. So every month you spend $200 to buy shares. Instead of just spending 2 million at once, you'll be buying it on a weekly basis, on a monthly basis, on a yearly basis. No, there's a frequency which you are using to buy the shares. So the good thing about it is that you're able to buy the average price instead of buying at the top price. The stock market moves like this. It goes up, it comes down, it goes up, it comes down, it goes up, it comes down. So if you buy at this point, you are buying at a high price. If you buy at this point, it's at a high price. So you want to buy whether it's high or low. And how do you know that? You buy on a frequency, on a monthly basis, on a weekly basis. So you buy a fixed amount, $100 every month, so that you buy the average price instead of buying only at the high price. But if you can buy only at the low price, that's even better. How do you know the low price? That's a problem. Finally, let's talk about news and emotion. News move the market. If you're an investor, you just buy it and hold it and live your life. Except you're a trader. It's a trader that's worried. Hey, what's the news? In my stock market, is my stock going up or coming down. It's a trader that's worried about all those news. You are an investor, not a trader. So calm down, invest in it, and do something with your life. Don't be checking the news because the news move the market up and down. I told you this thing goes up and down. It's the news that make it go up and down. If it's a good news, the price will go up. If it's a bad news, the price will come down. That's what I'm saying, that over years, over a certain period of time, it will likely go up in the case of S&P 500. Diversification, in the sense that don't just invest in stocks, also invest in ETF, invest in mutual fund, invest in bonds, invest in cash, invest in alternative investment. You have low risk asset, medium risk asset, and high risk asset. So you can see how they are classified. For low risk asset, it's just savings in the bank or buying like an insurance plan. They are low risk asset, or having cash at hand is low risk asset, or buying treasury bills, they are low risk asset. These ones, the return you will get is like the interest you get from a bank. The interest rate is very low. Also, the risk is very low. When you go to the bank, you are sure that your money will be there. But if you want to move to a medium risk asset, that's when you start buying about shares, about property, about ETF and mutual funds. This one, the risk have increased to 10%. The return have increased to 10%. Here, we're looking at something between 0% to 10%. So here, we're looking from 10% to like 100%. When we go to the high risk asset, we're looking from 100% to infinity. This is what we call trading. Futures, options, CFDs, spread betting. It involves trading. You are trading securities. You are speculating for it to move up or down. It's very risky. Also, it can be very rewarding. But that's not our focus in this class. So that brings us to the end of our class. And please, I would highly encourage you to read this class and review this class. So if you want to pack money from the stock market, Packer Johnson Packer. Smash the like button. Wale, smash the subscribe button. Thank you.